Hello, welcome. My name is Eugene. I am a lecturer in Kenya. I teach professional courses such as SCCA and CPA. My videos cover various topics found in these professional courses. The main subjects covered are management accounting, performance management, and quantitative analysis. I welcome everyone interested in learning something. Sit back, relax, and let's begin. In this video, I will take you through cost volume profit analysis. Introduction. Cost volume profit analysis helps businesses to understand the relationship between costs, sales volume, and profits. Some assumptions of CVP analysis are: 1. The total cost is semi-variable. 2. The variable cost per unit remains constant. 3. The selling price per unit remains constant. 4. All the units produced are sold in the same period. Some applications of CVP analysis are: 1. To determine the break-even point. 2. To set selling prices. 3. To determine the most profitable product. 4. To determine how the profit is affected by changes in variable costs and fixed costs. At the break-even point, the profit is 0. Break-even analysis for a single product. Example 1. The selling price of a product is $10 per unit and the budgeted sales volume is 7,500 units. The following data has been provided about the output units and their corresponding total costs. Required: A. Calculate the break-even units. B. Calculate the contribution to sales ratio. C. Calculate the break-even revenue. D. Calculate the margin of safety units and as a percentage. E. Calculate the sales volume and sales revenue required to make a profit of $10,500. To calculate the break-even units, we divide the fixed cost by the contribution per unit. Use the high-low method to calculate the variable cost per unit and the total fixed cost. Using the high-low method, the variable cost per unit is $7 and the fixed cost is $9,000. The contribution per unit is the difference between the selling price per unit, 10, and the variable cost per unit, 7, which gives us $3. In that case, the break-even unit equals to 9,000 divided by $3 per unit, which gives us 3,000. To calculate the contribution to sales ratio, we divide the unit contribution $3 by the unit selling price $10. That gives us CS ratio of 0.3. To calculate the break-even revenue, we multiply the break-even units by the unit selling price, which is 3,000 times 10, giving us $30,000. Alternatively, we can calculate the break-even revenue by dividing the fixed cost by the contribution to sales ratio. In that case, we'll take the $9,000 divided by 0.3, which will still give us $30,000. To calculate the margin of safety units, we get the difference between the budgeted sales units and the break-even units. In that case, we'll subtract 7,500 and 3,000, which gives us 4,500 units. To calculate the margin of safety as a percentage, we'll divide the margin of safety units by the budgeted sales units times 100. In that case, we'll take 4,500 divided by 7,500 times 100, which gives us 60%. To calculate the sales volume required for the target profit, we'll add the fixed costs and the target profit and divide by the unit contribution. In that case, we'll take $9,000 plus $10,500 divided by $3 per unit, giving us 6,500 units. To calculate the sales revenue required for the target profit, we'll take the sales volume required times the unit selling price. In this case, we'll multiply 6,500 by $10, which gives us $65,000. Example 2. A company manufactures and sells a single product with a variable cost of $25 per unit. It has a contribution to sales ratio of 20%. The company has a fixed cost of $10,000. Required, calculate the break-even point in units. At this point, you can pause the video and try to work out the break-even point in units, then resume playing the video to see if your answer is correct. Break-even units equals to fixed cost divided by unit contribution. The CS ratio is 20%. This means that the contribution per unit is 20% of the selling price per unit. In that case, the variable cost per unit is 80% of the selling price per unit. We are given that the variable cost per unit is $25. Since the selling price is 100%, we'll take 100% divided by 80% times $25 to get the selling price per unit, which is $31.25. The unit contribution is the difference between the selling price per unit, $31.25, and the variable cost per unit, $25. That gives us $6.25. Using the formula, the break-even units will be $10,000 divided by $6.25, which gives us 1,600. I hope you enjoyed the video and learned a lot. Please support the channel by subscribing. See you in the next video. Goodbye.